Okay, now we're going to continue with the lecture on Chapter 3 for investments. And we're going to start by talking about the different markets, the U.S. markets. We're talking about the NASDAQ. NASDAQ has about 3,000 different companies on it currently, or I should say currently from when this book was written. But the electronic communications, and since this uses electronic communications for trades, it's been the one that's growing quite a bit because of the speed and rate of trade has just increased exponentially over the last, well, several decades, but especially in the last 10 years or so. The speed the trades can happen is just growing. So there's 3,000 firms, and the great majority, the current version is called the NASDAQ Market Center. Yeah, that consolidated the NASDAQ's previous electronic markets into one integrated system. It merged in 2007 with OMX, a Swedish-Finnish company that controls 7 Nordic Baltic stock exchanges, to form the NASDAQ OMX group. In addition to maintaining the NASDAQ stock market, it also maintains several stock markets in Europe, as well as options and futures markets in the US. So the New York Stock Exchange is a secondary market where already issued securities are bought and sold by members. So the group, the NYSE group, in 2007 merged with the European exchange Euronext to form NYSE Euronext. So what you're going to see, just like it was in the prior, we're just consolidating across the board. We're becoming more and more global, and our trades are becoming, our trading and our investing and our equity is just expanding to not only from the United States elsewhere, but also from European markets, Chinese markets, all kinds of markets across the world. ECNs, latency for ECNs, the time it takes to accept, process, and deliver a trade order. So the time from which someone says they want to buy something to the time that it actually happens is referred to as latency. It has gotten faster and faster and faster. The faster it is, the more real time. The more real time it is, the more you can trade quicker, the more accurately you can trade. So it says, for example, BATS is what the book says. For example, advertised in 2017 that its latency time was 100 microseconds, which would be 0.0001 of a second. So you can see that there's really, latency times are getting to be almost non-existent. They are technically still there, but they're getting more and more, the numbers getting so small, it's almost like it is real time. All right, the market shares of trading on the NYSE shares. It's on page 64 in your book. This is from Equity Trading in the 21st Century, the Quarterly Journal of Finance from 2011. So this shows the market share of the NYSE, and you can just see that it has dwindled. NYSE was the largest, and now it is all kind of grouped together. This is happening not just due to the fact that NYSE didn't shrink as much as what the other ones have grown, and also just mergers between them have basically consolidated and started to consolidate more and more to show that their market shares are all relatively similar. And just like in any other business and economics, the kind of competition drives this for the markets themselves. All right, algorithmic trading. The use of a computer program to make rapid trading decisions. So fast, quick trades that we've been talking about. Computer programs are doing a good portion of those. When we talked in a prior video about puts and about buy and sell orders, those are happening rapidly, happening in milliseconds or microseconds compared to what it was before. I should say microseconds technically. And people are trading more frequently. Computer programs can make very rapid trading decisions for very small profits. What this should be leading to is a completely efficient market. I don't believe we've talked yet about the efficient market hypothesis, but if things are all priced correctly and properly, then that means that you should technically never be able to beat the market. You should always be able to simply trade at the rate whichever one else is trading. To put it really succinctly, that's like if you look up the efficient market hypothesis and you look for the journal article, it's one of the most publicized finance articles. I would recommend actually going to read it. If you just go to Google Scholar and you search efficient market hypothesis, not the easiest. It's not the easiest paper to understand, but it is a major paper in the area of finance, and something that if you're a finance major, I recommend looking at. And it's by Fama It was written in 1960 by Eugene Fama. If you want to see, I don't have the version of it right now, but you can find that out there online. Or you can actually go through our library to find it too. Okay, dark pools. ECNs where participants can buy and sell large boxes of securities anonymously. One issue, especially when we're getting more and more into hedge funds, mutual funds, and then just the super wealthy that trade, is people tend to follow what other traders are doing. When that happens, that can affect the market in a positive or a negative way, depending on what whether you're following or doing the opposite of what someone's doing. So dark pools are intended to not allow people to know who's exactly trading, so they're trading in blocks instead. So effectively, they're trying to fill up that block for a number of shares that need to be traded, and they say we need to buy or sell or whatever these 10,000 shares, and maybe only 100 are going to one place, and another 1,000 are going to another place, and another 2,000 go to another place. But it blocks them all together so that you can't see specific moves that specific individuals, companies, mutual funds are actually making at a given time. That way, people can't just follow what someone else is doing. Moving to automated electronic trading, which is happening all the time now. Current trades eventually result in a 24-hour global market. So like I mentioned in a prior video, while there is technically a close on the market, there really is trading pretty much all day, all around. And the more consolidated we get and the quicker our technology moves, the more we're moving to a 24-hour global market. Eventually, while I don't think you'll ever see a consolidation of all of these markets together, eventually you're going to get down to a very few, very large markets that will be serving the entire global market. And it's already headed there at this point. Market capitalization of major world stock exchanges in 2016. So you can see NYSE is still the largest here, but you see that all these, and if you saw a chart of this, I don't think they have one in this book that I recall. If you saw a chart of what this did over time, this is a snapshot of a single date or single time in 2016. But if you saw a snapshot of what this looks like in time, you'd see that NYSE is still the largest, but that all the rest of them are growing at a more rapid rate due to globalization, generally speaking, compared to the NYSE. Okay, what does it cost to trade? Okay, so commission fees are paid to a broker for making a transaction, so a fee to buy and sell. A spread is the cost of trading with the dealer. Okay, so a bid is the price at which the dealer will buy from you. The ask is what the price will sell to you. The difference between those two, the ask price versus the bid price, is the spread. We talked about this in a prior video too, where there's a difference between what someone's willing to sell for versus what someone's willing to buy for. And on some trades, both the spread and commission would have to be paid. It depends on the trade, and it depends on who's willing to sell. Margin. Buying on margin describes securities purchased with money borrowed from a broker, the net worth of the investor's account. So a broker is utilizing their money that the investor, the specific investor, is borrowing from them to buy stocks on their behalf. The initial margin requirement, usually a minimum set by the Federal Reserve under Regulation T, is currently 50% for stocks. So this is the minimum percentage of the initial investor's equity. So while they can borrow money, they can't borrow beyond 50%. They have to have 50% at a minimum to buy on margin. So 1 minus the IMR is the maximum percentage I think that they can borrow, the initial margin requirement. But notice it says initial, this is in the first place. It doesn't necessarily mean that that money might not be utilized elsewhere at a future date. Okay, equity, position value minus borrowing plus additional cash. So equity, just like it's defined in accounting, we're talking about position value, that'd be the value of what you own, minus borrowing, that'd be like liabilities, and then plus any additional cash flows from the cash requirement would be additional assets. So really similar to how it's defined in accounting, just kind of said differently because we're talking specifically about an external asset, not something within our organization. But really the term is still the same. Maintenance margin requirement. The minimum amount of equity that can be for additional funds must be put into the account. Exchanges generally mandate a minimum of 25%. So if you reach that barrier of 25%, then you can't necessarily continue trading unless you add additional funds into that account. So it's a barrier, low barrier that you have to exceed at a given time when you're buying on margin. Margin call is a notification of the broker that you must put up additional funds or have a position liquidated. So effectively that would mean a margin call means that you have reached this mandate, okay, you've reached this lower limit, and the broker notifies you, hey, you're approaching or you're at that limit, and if you don't put more funds in the account now, then we're going to have to liquidate your position, meaning in this case likely sell a stock because you are not following the rules of the minimum margin mandate, the minimum margin requirement, excuse me. Okay, if equity and market value is less than the margin requirement, the minimum margin requirement, then a margin call occurs. So that margin value minus what borrowed money divided by the market value would be that maintenance margin, it's a maintenance margin requirement. So in this case, a margin call will occur when the market value is less than the borrowed amount minus over 1 minus the MMR, that maintenance margin requirement. So the maintenance margin requirement is 25%. The amount borrowed divided by 75%, if that's my MMR, can't be greater than the market value. If it is, then that's when the margin call will occur. So I'm going to go through this example in the next video.